Hello folks, I'm L.A. Little and this is your weekly NeoTA wrap where we take a look at these markets and we do it from a neoclassical perspective, every time asking ourselves what happened last week and what does it tell us about the coming ones. As usual, I do this show every Sunday night and broadcast at 10 o'clock Eastern Time and archived on YouTube. You can view it on the L.A. Little channel, and of course there you can get it on any device 24 hours a day at your convenience. As far as these markets, what happened last week? Well, last week we actually finally had a decline after 5 weeks of up. The Russell still negative for the year. S&P's got hit pretty good last week, 1.1%. Dow Jones almost the same, and of course the NASDAQ doesn't want to give it up 9.5% still on the year. But I think that may change this week. We did see a push-up, a continued push-up on the S&P up until this last week. Then it started to roll over. It had broken out of a range. That range, a little tight range here, was about this area. There's one up underneath it, about the equidistance, just a slightly larger one. And you could imagine one higher on the weekly. But rather than move up, it rolled back over and is trying to get back inside that range. Top of it was 1984.85. Now close at 1985.54. So we're right at it, trying to get back into the the lower range, if you will, on a weekly basis. Volume really didn't pick up that much more as it rolled back over. As it's coming back into this big bar, you got 174 on that one. You're coming back in with 147. So we're going to have to see volume pick up if we're going to get back into that range. This week, of course, the big news is Yellen. She's going to be doing a press conference after the Fed meeting releases its announcement on Wednesday. So that's the big event of the week. There's some data coming out Monday, some data on Friday, Thursday, and Friday. But the big event, of course, is the Fed. And we've started to see, depreciation in bond prices and anything interest rate sensitive. We've seen an increase in the dollar. All of that seems to be a precursor to the expectation that the Fed is going to tell us that they're going to raise the rates finally. The markets, either the markets are ignoring that or the markets think it doesn't matter, that the economic picture is improving to the point that the Fed, as the Fed has told us, that the market can participate with higher prices even with the Fed raising interest rates. It's kind of amazing. We've got to nurse it along, nurse it along. So far the Fed has convinced the world and these markets that interest rates being increased is not going to be an issue, that they've got everything under control and everything's going to be fine. Well, maybe it is, maybe it isn't. I don't know. All I know is so far they haven't recognized it as a negative. This week we'll find out if they're really going to recognize it as negative or not, if in fact the Fed gives us higher rates, or at least the outlook for higher rates. If you look at the other indexes, there you're going to see the Russell being the weakest one, trying to come back in, and the strongest one, the NASDAQ, the NDX, still holding on a daily basis. You can see that little range, still holding that range, hasn't given it up at all. That to me is probably the place to be watching. If you start seeing these break down or break out, it's about 15 days of this. That would be the key. Are you going to get a range breakout to the top side or back to the downside? If it comes back to the downside, it's going to be a retest regen off these prior highs. I suspect that has a good chance of happening, but that really is going to be totally dependent on what the Fed tells us probably on Wednesday. So that's a quick look at the indexes. If you think about it from the sector perspective, on the sectors, really not that much different than they have been. We have seen some weakness in a couple of areas. In particular, we saw the SOX last week. We have to look at these on a daily basis to see it. The SOX starting to roll over, doing a little ABCD structure on the downside, but these are such minor moves, they don't mean much at this point. Yeah, you can get a minor move into this low. The XLE being hurt on the Russian sanctions, and that's been kind of a straight line move to the downside, breaks under the lows. If you look at it on the weekly, there's actually an ABCD structure here to the downside, but that doesn't measure all that far either. I mean, there's another move here taking place that gets you down into about the 91 area. There is a nice big strong support bar here at 93, so to me that's going to be the one to watch on the downside. First one to break back down lower on the daily is still sideways on the weekly, but on the daily here you've got a suspect break to the downside, and now you got a break of another swing point low. So XLE, SOX, those are probably the two weakest sectors, but you still got strength elsewhere. XLF, you know, XLK, XLV, XLY, they're all holding up at the highs, range trading at the highs. Can be consolidation. If we break lower, people will say it's distribution. That's only in hindsight that you know that. Right now, these markets are still hanging up here at the highs for the most part in most of these sectors, and even in the indexes themselves, they're really not giving it up yet. If you look over at the interest rate sensitive parts of the market, there you're going to see a lot different situation. And what I mean by that is about 2 weeks now we've had pretty much a straight down move in these interest rate sensitive type areas, and they have shown no sign, you know, of a pullback, you know, any kind of a bounce. I'm sure they'll get one at some point. You have a little doji here. I'm looking at the DBA. This is a result of the strength in the dollar to a great extent. In other words, if I look at the dollar and I see how the dollar is behaving, you know, the dollar has been nothing but up all the way. There's really no pullback whatsoever here in the dollar. If you look at it on a weekly basis, you know, this was a huge move to the upside on the dollar, just straight up. And yeah, it's over the highs, and yeah, it may come back and do some consolidation. Certainly on the daily it looks like that. But a stronger dollar does what? It does two things to equities, and it does two things to most anything that gets sold overseas. It makes it harder to sell it, right? And it also puts pressure on the equities from an exchange point of view. In other words, what you're selling overseas doesn't mean as much to your bottom line anymore, and unless you've you know, negated that effect through your currency hedges, you're going to get hurt on those decreased revenues. Looking at the continuous commodity index, looking at a few of these others, you can see the kind of hurt that's taking place. Let's look at the interest rate curves. Here's the junk bonds getting hit. Even the high quality corporate bonds are starting to get hit. The municipal bonds have been hit, and everything on the longer end of the curve is getting hit with respect to like TLT and so forth. So when I look across the spectrum, I can see a huge difference in the last 2 weeks in anything interest rate sensitive. All of them weaker, all of them telling us that the Fed is going to do something, and do something fairly quickly. Whether we're told that this Wednesday or not, and whether it has an effect on the equities or not, is really the question. If you ask me, the equities so far haven't given us an indication that that's what's going to happen. So if I look at you know, the total picture and do my summary that I try to do, it looks to me like what you're going to see here is you're going to see equities hang for the first couple of days this week until Wednesday's meeting, that announcement, and that Fed, that follow-up conference where, you know, reporters are going to press Yellen with respect to, okay, what's going to happen here? Are we going to see these interest rates move up faster than you've told us? Or is it really still going to be, you know, second, third quarter next year before we see any kind of interest rate rise? If it's the latter, these markets are probably going to move right back to the top of the range and try to break out. If it's the former, that the rates are going to increase sooner than we expect, then we're going to find out whether these markets from an equity perspective care or not. So far, they're acting like they don't. Everything else acts like it's coming, and they're readjusting based on that assumption. Will equities adjust? We'll see. Also remember, earnings are only 3-4 weeks out now. So we're 2/3 of the way there again before we start getting the next batch of earnings. I haven't seen much in the way of declining expectations on those earnings. And given that, you have to assume either those earnings are going to have to meet those expectations, or they're going to get ratcheted down the next 2 to 3 weeks, or we're just simply going to have disappointments, because I do expect that dollars are going to hit the bottom line on some of these corporations. So that, in a nutshell, is the wrap. What we're going to do now is shift over and do a little bit deeper dive in some valuations. I wrote a piece last week, and I want to pop over here. And what I want to do is talk about what this piece was about. You see all sorts of things in terms of the Shiller Cape Index, the other types of valuation models, PEs, both forward and trailing PEs. You get a lot of mixed picture. I mean, the Cape Index is telling us that we're extremely overvalued. The trailing PE looks like somewhat overdone. The forward-looking PE, it looks like it's fine, right? I mean, market's not overvalued. Depending on what you want to look at, you can come up with a lot of different conclusions. And one of the questions I asked was, and I know this is not a perfect model either, none of them are, but I just said, okay, well, what about the ratio of, the equity increases with respect to gross domestic product increases? And I looked only at the U.S., even though I did the numbers on the world and looked at them too. I don't think that, I think this one probably is still closer, matching, and especially if you look at the GDP and the expectations on the, not the expectations, but the increases on the Russell. And so from 1981 to 1990, I went back in time and said, okay, over the last 4 major peak-to-peak recession periods, what did it look like in terms of how much the gross domestic product increased and what kind of increase we saw in the markets? Now, Russell wasn't, there wasn't an index to compare back then. So if you look at it just in perspective of the S&P and the NASDAQ increased at about the same rate as the GDP. The S&P was at about a 2 times factor. Moving forward, I've got it in here twice. Moving forward, if we look at it here on the first quarter 2002. Actually, I've got the wrong one in here. If you look at the, I've got the wrong label in here. If you look at it from not 81, but from 91 to 2000, that was what this one was really. This one showed a huge increase. And let me get the right chart for us here. I actually happen to have it on the site. Actually, I'll have to correct this, but I do happen to have the correct charts. I believe I have them handy here. I don't, but let me just recite what it was, and I'll get this corrected so you can see it if you want to read the article. But it was going in the 1990s, there was a huge increase. It was about a 5-to-1 increase in terms of the numbers with respect to how much equities increased versus how much the GDP increased. And that was from 1991 up until 2000, the year 2000. And so you know that, if you remember, that was the tech bubble. That was when we measured eyeballs and stuff, and it was a huge increase. That big increase, that big spike, led to the next period where we went from peak to peak on the recession. Led to that next period where we didn't see that sort of increase. And now the Russell we did, but the GDP outran the S&P, outran the NASDAQ up into the 2008 recession. If you look at what's happening now, you've got the same sort of graph, and this is what that graph back in 1991 up until 2000 looked like. You've got a huge spike up one more time in the valuations compared to the GDP. In other words, we're not getting the GDP bump, yet we're getting huge increases in valuation in the S&P, in the NASDAQ, in the Russell, almost mirroring what we saw in that tech bubble back in 91 to 2000. Not quite there yet. I mean, there we had 5 and 6 times increases. Right now we've only got something on the order of 3, 4, 5, depending on which ones you're looking at. But the point is that we're in the sort of bubble that we saw in the 90s. That's what was taking place right now. How far can it go? Well, it can certainly go to what we saw in the 90s, I guess. Certainly our valuations now don't look as crazy because of what took place in the prior run-up to a recession. And we certainly don't have a recession yet. But when we do get it, right, these valuations suggest that we're going to have a fairly large change in valuation, in other words, decrease in the equity prices, and that when we get the increase for the next peak to peak, in other words, once we come out of the recession, I suspect it's going to look more like this than this. And so that, looking forward, I think that's something that one should consider, in terms of valuations. We're probably overvalued. We can get more overvalued. And when we move into a recession, we're probably going to get a fairly steep correction again, just like we saw in 2000, just like we saw in 2008. And then when we come out of that, I expect that we're not going to see the kinds of huge increases in equities relative to GDP. So that, in a nutshell, is just kind of a valuation deep dive, something I wanted to share with you. And a weekly broadcast is a good place to do that. Moving back to the markets, let's talk about a couple of other things. And I want to look at these markets. I want to look at the bond prices and those changes on a longer term basis. So we just saw the steep declines with respect to the bond prices. I'm looking at the TLT, the 20-year, with respect to the weekly, the dailies. Look at them on the weeklies, and what I want you to notice is on neoclassical, we try to look at it from a perspective of the volume flows, right? What kind of volume increases or decreases are we seeing with respect to price increase and decrease? Very steep sell-off. You went from 119 all the way down to 113. That's $6. That's a huge percentage. That decrease from a perspective that is fairly significant and worth looking at. 2%, 4%. So about, and if you came off the highs, which it almost was, it's about a 5% decrease in 2 weeks. That's a big move in the bond market. And the last time we saw any huge increases in the bond market in terms of equity flow or volume flows really was back here when we came off these lows. We eventually came down and tested them again, and then we saw a nice spike again in this as it pushed higher. But since then, other than this one spike in volume here, there really hasn't been the increase in volume on the way up. Now, even though that was the case, we still, on a weekly basis, saw ABCD structures come and fulfill. We actually had another one in place here that didn't quite get finished, and now we're seeing a steep decline, back to the backside. And matter of fact, the thing to watch now on the bond market, and what I'll be watching when the Fed does its thing, is how does this retest regen on the weekly play out. Clearly we're coming back at that weekly, and we're coming back with a nice volume spike compared to the volume over there on the weekly bar itself. You also need to look at it from a perspective of the breakout. Here is the breakout, no volume there. So we're coming back with a lot more volume on the way back than on the way up. That suggests that this big move up may be over. So let's pull that out now and look at it from a monthly perspective. Let me grab the monthly chart here. If we pull it over and look at the monthly chart, we actually have two things happening. One is the range trade that was up here at the highs versus the range underneath, about equidistant. We got over and into the higher range last month. So far this month, and we're only halfway through, but so far this month we're pulling back into the lower range. That pullback, if it holds, says that the test into the higher range has failed, right? And we're going to play around in the lower range, or maybe we're going to play around in this area for a while. Note, even though the volumes on the weeklies didn't look that bad in a couple places, this whole spike up in the bond market, bringing rates down, this entire spike back up came on very low volume comparatively. The bar it's coming into, you can see the volume here fairly high. The volume spike on the way up, right, when we got the big spike up, those volume trails, nothing like that anymore. The suggestion to me is that this whole move up may finally be playing out, in other words finishing. That ABCD structure, I'm going to go back and look at history here, that ABCD structure on the downside finished out. Then we saw an attempt to push it up and create an ABCD structure to the upside to get us all the way back up to these highs. So far that's held, but it's under pressure. And so bond rates look to me, or bonds themselves, the interest rates look to be going higher, bonds themselves selling off, and that's on a long-term perspective. Not on the weekly, not on the daily, but on the long-term perspective. So if anything, once more, this underscores the idea that we've probably seen the lowest rates we're going to see. And if we were able to pull this back, and I don't have a chart up easily here and it doesn't go back that far, but if we pulled this back and looked at it from 1980, what you would see is a huge bull market since 80. And that bull market has been going on now, since, oh my goodness, 1980 to, what is that, 34 years? It's been a bull market in bonds for 34 years. It takes a while to break that down, but I think you're starting to see the slow rollover, if you will, of bonds of that bull market. And what's going to really tell us that is when these lows break, if they do, right? This low here, if it breaks, would do what? It would take this sideways trend and turn it to bearish. And that would be the first time we've seen a bearish trend on the long-term time frame in bonds for more than 3 decades. That would be a huge deal. What would it mean to the markets? Well, the big part of that is that you can actually start to see interest rates increase and maybe get something back on your money. But what it really says is that the bond market might not be a bad place to make money in a larger way as it starts to roll back over, because the multiples, given the way rates have gone, the multiples are going to be huge. So you don't want to be invested in bonds. You actually want to be shorting the bonds, because that rollover, when it takes place from these extremely low levels of interest rates, it's not going to crimp equities that much. In other words, it shouldn't it shouldn't crimp them that much, because in other words, if you go from 1/4%, or take a 4% bond or a 4% loan, if you go to 4.5%, it doesn't make a huge difference in terms of whether the project makes sense or not, or 4.25%. When you get up to 5, 6, 7, then it's going to make an impact. And so that impact on decisions as to whether to invest in plant, equipment, and all that stuff, it's not going to change that much initially, because those interest rate increases are going to be fairly small probably initially. But at some point it will make a difference. But where it's going to make a huge difference is it's going to make a huge difference in anybody that's in these instruments themselves as they start to roll over. So if anything, this might be an opportune point to start thinking about bonds and start thinking about shorting bonds again, which we have laid off of ever since it started making these runs higher. And it was, the right thing to do. Now, potentially the right thing to do is to think about the other side of the equation again on the next big bounce. And that bounce may come Wednesday if the Fed tells us that nothing's going to happen. But folks, rates are going to go up. They're not going to go down. There's no place to go on the downside. Eventually they are going to go up, and that's where we should be looking for a potentially larger trade. All right, well, that's it for this week. Thanks for joining me. I will see you tomorrow at the regular 10 o'clock Eastern time, and we'll look at it from a daily perspective. Again, expect this market to probably just hang up here in terms of equities until Yellen starts telling us what she really wants to do, and then we see those reporters probe her at the press conference after the great decision. Till then, take care. I'm LA. This is and was your weekly NeoTA wrap. Have a great